the types of questions that can be asked from a provisional tax perspective. So effectively, this will show you how to answer provisional tax questions. And what I'll do after that is I'm actually going to be doing the board exam question from January. That will show us how to answer an individual's question, around about a 20-odd mark individual's question. And after that, for the 4862 students, if you want to stay, I'm going to do a quick revision on what happens when people die for estates. So not examinable for the tax 4861 guys, but it is examinable for 4862, and I'm going to be going through all of the stuff itself. So I just want to actually, that's the outline of tonight's lecture. Let's just take a step back. This is the last lecture that we've got before you write your third test. So let's just basically just unpack what you guys should be expecting. So the questions have not been set for the test, but as you've seen, there's always going to be a number crunch component within a test. There's also going to be a discussion component within a test. Okay, you're safe to assume that at least half the marks maybe will be split that way. Sometimes it's like 60-40 one way, other times it's like 60-40 the other way. But you guys need to be preparing for a number crunch type question and discussion type questions itself. You'll see in the board exam, guys, there was a number crunch question on individuals and a discussion type question on employees tax. You'll see that a little bit later. So I want you just to actually think about it. From a provisional tax perspective, there is number crunch. For employees tax, there's number crunch. Or you could get a normal individuals tax calc type question. For the guys in 4862, it is possible for you to get someone that dies. It's also possible for you to get estate duty, but estate duty is at a level 1. So it's going to be not a very complex thing, a couple of marks on estate duty if you're going to get estate duty. So those are the number crunch type things that you need to actually just think about. So you need to make sure you know how to do a number crunch for an individual, number crunch for employees tax, and what we're about to do now, a number crunch for provisional tax could be asked in a paper. Provisional tax in last year's year-end exam, there was around about a 10 to 15 mark question on the stuff that I'm doing tonight. So it was asked in last year's year-end exam. So just give you a little bit of a heads up with it. Now, I've treated this as a tax case study, a teaching case study. This is not the way it'll get asked in an exam, but it's asking each of the questions you might get in an exam. So having a look at task 1 instructions. It says, discuss whether any taxpayers listed will have to register as a provisional taxpayer and indicate when their provisional tax payments need to be made. So this is the first type of question. Do I need to register as a provisional taxpayer? And that's what this section deals with. So guys, before we actually have a look at whether someone needs to register as a provisional taxpayer, what I've done as part of the case studies, I've given you a little bit of a theoretical background. Okay, so let's just discuss when do you need to register as a provisional taxpayer. So let me do the theory with you first, and then we'll go through and we'll practically apply to the question. So guys, it says provisional taxpayers according to paragraph 1 of the 4th schedule are all companies except PBOs or recreational clubs or body corporates or share blocks. Okay, so all companies need to register as a provisional taxpayer. Is it possible for you to get a company in this test? Absolutely, because we're doing topics 1 to 4. So you could get a little bit of provisional tax on a company, and there's a little bit inside this case study with you. So all companies are provisional taxpayers. It says number 2, the second dot, any person notified by the commissioner to be a provisional taxpayer. So in the question, if it says SARS has notified you that you're a provisional taxpayer, you're a provisional taxpayer. And then it says a person who derives other income which is not remuneration. So let's just unpack this and let's just understand it. If you earn remuneration, guys, what we did last night is we did employees tax. So when you earn remuneration from your job, or you get a pension payout, there's employees tax. You don't need to pay provisional tax because there's employees tax. So when is there remuneration? When is there provisional tax? When it's not remuneration. And we're just going to unpack this a little bit more to make sure that you understand how this works. So it says a person who derives income which is not remuneration. Okay. Okay. It says here, if a person receives income from dividends, foreign dividends, interest and rentals from fixed property of less than 30 during the year, there is a provision that you need not register. So guys, what are we saying? If you receive stuff that's not remuneration, you need to register unless, if it's less than 30K, not provisional tax. You don't need to register. And guys, let me just put it forward this way. It's your income needs to be more than 30. So if your interest is 40,000 Rand, 23,800 will be exempt, 17 will be taxable. You do not need to register for provisional tax. It's only when your income is more than 30,000 that you need to register for provisional tax. Or the next thing, it says there's also no need to register if the income is below the threshold for tax. So let me just explain what this means. So let's imagine this is you. You get a rebate of 17,235 because you're under 65, which means that you do not need to pay tax unless you earn more than 95,750 Rand for the year. Because if you earn 95,715, you will pay tax at 18%. You'll get a primary rebate of 17,235, and you will not have to pay any tax. So you don't need to register if you are below the threshold. So no registration if below threshold. Now, guys, it depends on what happens in a question. So effectively, guys, having a look at the question that I've got here, it says here, Carol, 78 years old, and Harry, 79, Burnett are married couple that were married in 1971 in community of property. Okay, so as far as this is concerned, guys, what is their threshold? So guys, their threshold is over here inside the question in my discussion. It says a person over the age of 75 receives a primary rebate of 17,235, a secondary rebate of 9,444, and a tertiary rebate of 3,145. So if we had to add all three of those together, we would add together 17,235 plus 9,444 plus 3,145. Okay, you would pay tax at a rate of 18% on the table. So unless your other income is more than 165,689, you don't need to register for tax. Why? Because you will simply get a rebate of 29,824 and you won't have to pay any tax. So let's practically apply this and let's just discuss it. It says when both of them retired, they received retirement lump sums and they purchased a portfolio of rental properties that will earn 250 per annum, 125 each. Why is it 125 each? They're a couple that were married in community of property. So each one of them gets 125. It says Harry still works, earning a salary of 50 a month from his employer Radius Limited. Radius has a December year end. Carol is ill and her daughter Melissa takes care of her. Carol and Henry pay Melissa 20,000 per month for taking care of Carol. Carol and Henry are not registered as employers with SARS. They accordingly do not withhold employees' tax on payments to Melissa. Marius Burnett, their 52-year-old son, is a plumber by trade and earns approximately 100,000 per month after paying for all support labor and parts used in the course of his trade. So let's just do Carol first. So what has Carol got? She's got 125,000 Rands worth of investment income. And let's just unpack what we know, guys. Essentially, what's going to happen with someone that's in this situation? If you earn more than 30,000 other income, not subject, normally you need to register unless you're not required to register. So let's just have a look at what it says for Carol. It says the rebate available to Carol and Henry is 29,824. I just did that as they're over 75. The tax threshold is 165,689. What's basically going to happen, guys? Unless they're earning more than 165,689, they do not need to register for provisional tax. It says here, as Carol's only income is 125, a 50% share of the rental income, she will not be required to register as a provisional taxpayer because she's below the threshold. So she does not have to register. Why? Because if she was to submit a tax return, she would say 125,000 income times by 0.18 gives you 22,500 minus 29,824 rebates, means that she doesn't pay tax. She doesn't have to register. Henry now. Now, what did the question say about Henry? It said that he earns 50,000 Rand salary per month from his employer. So Henry earns 600 plus 125, which is 725. So guys, the moment you earn more than 30,000 Rand, that is not subject to remuneration. This 600 is remuneration, there's employees tax. But this one is greater than 30,000. So is Henry required to register? Yes, Henry is required to register. So have a look here. It says Henry earns a salary of 600 per annum and 125 rental. This is above the tax threshold of 165,689 for him, and he's liable to pay tax. Employees tax paid on the salary. The 125 rentals are not subject to employees tax and are above the 30,000 threshold. So because he earns more than 30,000, that is not subject to remuneration, he is required to register as a provisional taxpayer. Okay. So guys, are you required to register? More than 30? Yes. So essentially there's two tests. Now with Melissa, then we're going to do two tests here. What's going to happen with Melissa? With Melissa, what happens with her? She gets 20,000 Rand a month. There it is. 20,000. Okay. No employees tax on it. That's 240 per year. So is she above the threshold? Yes. Is there more than 30,000 that is not subject to employees tax? Yes. So Melissa is going to have to register as a provisional taxpayer. So it says their daughter Melissa receives a salary of 20, but her parents have not registered as an employer with SARS. She thus does not have employees tax. Her tax threshold is 17,235. She's 52, divided by 18%, 95,750. As the salary received of 240 is greater than the tax threshold and is not subject to employees tax, Melissa will register. More than 30,000 Rand a month, not subject to employees tax, and she's liable for tax. And Marius is a simple one. What happens with Marius? He's earning 100 a month that's not subject to tax. He's an independent contractor. He has to register as a provisional taxpayer. Why? Because he's got 1.2 million that's not remuneration. He has to register. He's above the threshold. And then with the company Radius Limited, all companies have to register for provisional tax unless they're a PBO, guys, or a sporting association, guys, they have to register for tax. So this is the first question. It might be a 3 or 4 marker in an exam where it says, should so-and-so have to register for tax? And how are you going to answer it? You're going to say, this is what their threshold is. They're above the threshold. Okay. It depends on how old you are. Okay. That's why I've done it like this. I've said, if you under 65, there's your threshold, the 95,750. If you're between 65 and 74, it's 17235 plus 9444 divided by 18%. Your threshold's 148,217. Or if you're over 75, it's 165,689. So the first thing you'll do is you'll say, am I above the threshold? If you are, you're going to ask, is there 30,000 Rand or more income, not gross income, income. So it's your net interest after your exemption. That is not subject to employees tax. If it's more than 30,000, you're required to register. So that's the first thing. So that's what I was doing with you first. The question is, do I need to register? And there's your answer. So this task 1 shows you, do I need to register? Next thing, guys, task 2. Let's look what it says. Task 2 says, calculate the minimum amounts that need to be paid for the first and second provisional tax payments in order to avoid penalties and interest. Okay, now what I just want to basically say to you is, you can pay just about whatever you want for a provisional tax payment. The question is, are you going to get a penalty if you pay that amount? So guys, when someone looks at you and says, calculate the second payment, that's not an exam question, because you can pay whatever it is that you like for a second payment. Okay? Just understand, if you don't pay enough, you're going to get a 20% underestimate penalty. So your exam questions don't say calculate a second payment. What they do is they say calculate a payment, which is a minimum payment, so that you can avoid having to pay penalties. Okay? So I need you to understand there's no correct answer for what is the second payment. There's a correct answer for saying what should your second payment be if you don't want to pay penalties. So I need you to understand that. Now, what I just want to do with you is I'm just going to do a little bit of a diagram. There is diagrams included in the notes I've attached for tonight, but I just want to do it so that you understand. Guys, if you're making a first payment, okay, inside the fourth schedule, it says for a natural person, you need to use basic amount. If you're making a first payment, it says that you need to use a basic amount. If it is a company, guys, you got to use an reasonable estimate of taxable income for the year. Okay. So for companies, you don't use basic amounts. That's not what the Act tells you to do. It tells you to use a reasonable estimate for taxable income. So in practice, what you should do is you should say, this is my first 5 months turnover profit, because you're going to be making your calculation before you've closed off for mid-year. So you've got 5 months worth of profit, plus the estimated profit for the next 7 months. That's what you're going to base it on if you're a company. And if SARS asks you and they do an audit on it, they will expect you to send across, this is the first 5 months trial balance. And here's my estimate. Here's an Excel spreadsheet estimating my profit for the next 7 months. That's what SARS will expect to see from you. That's what they want. Can that happen in an exam? Probably not. So your chances of getting a first payment for a company, not good. Okay? Because that's more like a MAC question and you need to have like more information given. What you can get in an exam is using the basic amount for a natural person. Okay, so what I'm going to basically do with you is I'm going to go through what the definition is of a basic amount with you. Okay, I'm going to go through what a definition of a basic amount is. So here, can you see inside this example, I've said for the first provisional tax payment, natural persons are obliged to use the basic amount unless a lower amount can be justified. You can use a lower amount, okay, but if SARS audits you, you need to be able to justify it. To be safe, basic amount. And it says companies must use a reliable estimate of income for the tax year that the payment relates to. That's why inside my example, I basically said, normally, if I was a SARS auditor, I would ask for and expect to see 5 months profit plus an estimate for the next 7 months. That would be a reasonable estimate of taxable income. Okay, so let's just unpack what a basic amount means. Okay, so guys, it says here, assume Harry Burnett is required to register for provisional tax and has provided you with the following information. Salary, 50 a month, and employee's tax is 18%. Various investments in fixed property shares, both local and foreign. Paid 8,000 Rand a month in membership to medical aid for himself and his wife. At 31 August, 13,000 expenses have not been reimbursed by medical aid. At 28 Feb, 20,000 expenses have not been reimbursed by medical aid. And here are the following details of previous tax assessments. So guys, to calculate a basic amount, you always need to use this for basic amount. And let me just go through what the definition of a basic amount is. So guys, you need to pay provisional tax if you're an individual on by 31st of August 2026. Okay, that's when you need to pay it by. Now guys, what SARS does is SARS says we need to give you a little bit of a heads up. So what we are going to do is we are going to go 14 days before this to the 17th of August. And we are going to say that is the date that you're going to use to work out your basic amount. Okay, so you are going to look for the most recent return on or before 14 days before the payment. So what is on or before that? Can I use that? No. Can I use that? No. Can I use this? Yes. Why? Because 14 February 2024, guys, what's going to end up happening? It's more than 14 days before the payment. Sorry, this is 2025. Apologies, sorry. Because you're doing the 2026 year. So first payment is 6 months into the 2026 year. So guys, I'm going to use that as my basic amount. So what's basically going to happen is if they ask you to calculate your minimum first payment, you're going to say, it's a human being, I'm going to use my basic amount, which is my most recent return before 31st of August 2025. 14 days before 17 August 2025, it's going to be this 433,226. Okay, so that's principle number 1. The next principle, guys, is a couple of things. So I'm interested in this at the bottom of the page. It says the 433,226 assessment included a lump sum of 20 from a pension fund and a net taxable capital gain of 10,000 included. When we work out basic amounts, you do the 433,226 and lump sums must get taken out and capital gains must be taken out. So when you work out a basic amount, it's always going to be without the lump sum and without the capital gain. Okay, so that's the next principle. So what is your basic amount? Your most recent return before 17 August 2025. So the 433. When I look at that amount, I need to take out lump sums and CGT when working it out. And then, guys, I am doing a 2026 first provisional tax payment for that year. I am 3 years behind. So the way that it works, guys, is that if you are more than 18 months behind, you need to add 8% simple interest for each year that you are behind. So looking at the solution, guys, sorry, clicked on the wrong thing. Guys, so looking at the solution here for task 2, I'm going to say I've got to use the 2023 tax years. The 2024 was received within 14 days. Due 31 August, received 28. So it's less than 14 days. So there's my basic amount. I'm 3 years behind. So first thing I've got to do is I've got to take 20 and 10 off, the lump sum and the capital gain off. And then I've got to add 8% simple interest. So I'm going to go 403,226 times by 0.08. And I'm going to add 32,258 for 3 years because I'm 3 years behind. And that's going to give me a basic amount of 500,000 Rand. So guys, first provisional tax payments based on your basic amount. So what have I taught you? It's the most recent assessment, more than 3 years, more than 14 days before payment. What I need to do for basic amount, always take off lump sums and capital gains. And if it's more than 18 months behind, add on 8% simple interest for each year part thereof that you're behind. So there's the calculation. And guys, I'm doing the hardest possible calc you could ever see for an exam. Exams don't normally have all of the stuff in it. I'm showing you the worst calculation. Okay. What do we then do, guys? We say tax per tables, less rebates. He is part of a medical aid, so what are we going to do? We can take off his tax credits. Sorry, I've actually made a mistake there. This is actually 728. Sorry. I'll actually post the correct one there. So it's him and his wife. His contributions are 96. Because he's over 65, you need to take off 3 times the 6A credit. Expenses not paid by medical aid are 13. Okay. And that amount you get to times by 33 1/3% because he's over 65. And there's the amount, guys, 51,378. It's only a half a year payment because remember, it's your first year payment. Less your employee's tax paid. The question said that he pays 9,000 Rand a month employee's tax. So there's no provisional tax payment that needs to be paid. Pure and simple. So that's the way that you do it. You're going to work out your basic amount, less your rebates, less your tax credits. Okay. Times by half because it's only for the first 6 months, less your employee's tax, and that's going to give you your payments. Now, guys, these calculations, I've given you a summary page for. So here, there, your first payment, guys, estimate, tax per tables, less rebates, less tax credits, divide the payment by 2, less employees tax, less foreign tax paid gives you your provisional payment. So guys, in the notes that I've attached to lecture session 3, there's your structure for your first payment. Okay, so that's what's going to happen. So first payment, guys, based on basic amount. Based on your basic amount. Okay, so that's there. Let's carry on. For him. What does the question say? It says, assume for the second payment, you know that taxable income for the 2026 year is 785,000, which includes a taxable capital gain of 40,000. So actual is equal to 785,000 Rand. Now, guys, let me just explain what's going to happen. And I'm just going to do a diagram, and there is a diagram in the notes just to help you with it. So included in here, guys, there is a calculation of this format. Where's it? Where's it here? Yeah. So guys, this is if you do the basic amount. There's a summary of the basic amount. And this is estimates of less than $1 million or more than $1 million. So what I'm about to do, it's actually in the handwritten summary. Let me just show you practically how to understand it. So for your second payment, guys, what you need to do is you need to establish whether your taxable income is less than 1 million or is your taxable income greater than 1 million. Okay, to avoid penalties, if it is less than 1 million, you can use the lesser of basic amount or 90% of actual. If your taxable income is more than 1 million, you can avoid penalties if it is greater than 80% of actual. Okay, so guys, for your second payment, if your taxable income is less than $1 million, you can use lesser of basic amount or 90% of actual. If it's taxable income of greater than 1 million, you got to pay at least 80% of actual. So let's just go back to the question. And what does it say? It says your actual 785, which includes capital gains of 40. Now, guys, you only take the capital gain out of the basic amount calculation. You do not take it out of your actual calculation. So my actual is 785, guys, or so I can use 90% of that amount, or I can use the basic amount. Now, guys, the basic amount might be different now. And let me explain why the basic amount might be different. Because your second payment is made on 28th of February, 2026. So if we go 14 days before that, we go back to the 14th of Feb, and we say, what is our most recent assessment before the 14th of February? So guys, our most recent assessment before the 14th of February is this one. Okay, that is my new basic amount. So what is going to happen? 700,000 is my new basic amount. Is it more than 18 months before? No, because this was for 2025. We're doing for 2026. It's only 12 months. And because it's not more than 18 months, we can just use the 700,000 as the basic amount. So what's going to happen, guys? We can either use actual times 90% or the basic amount of 700,000. So if we look at the solution, look what happens. I've got this here. To avoid underestimate penalties in the second payment, you need to use lower of basic amount or 90% of actual taxable income if taxable income is less than $1 million, or at least 80% of taxable income if it exceeds $1 million. There, guys. So what do? We say basic amount, 700,000. 90% of actual, 785 times 90%, 706,500. Lower of the two, 700. And then we're going to do the tax calc, which is tax per tables, less rebates, less medical tax credits, less employees tax, less your first provisional tax payment. How much is my second one? 13,216. We don't times this one by half. Why don't we times it by half? Because you're doing it for the whole year. The previous one we times by half. Guys, again, here's the format. I've given it to you in the handwritten notes. Okay. So guys, let's just unpack what we've done so far. Do we need to register? I've done a question. If it asks you for the minimum first payment, for a natural person, you're going to use the basic amount. And I've shown you basic amount, most recent return, at least 14 days before payment is due. So before the 17th of August for the first payment, before the 14th of February for the second payment. If it's more than 18 months behind, add interest at 8%. And for basic amount, take off CGT, take off your lump sums. Okay? And you can work out your minimum payments that need to be made. For the second payment, it depends on whether you are above $1 million or below $1 million as to whether you use 80% if you're above $1 million or lower of basic amount or 90% if you're less than $1 million. And this is a less than $1 million calculation over here. I'm going to do a more than $1 million calculation with you now in task 4. So there's your first and second minimum tax payments. Okay, let's look at task 3. It says Radius made a first provisional tax payment of 100 and a second provisional tax payment of 75 for the 2026. They've established that the taxable income is 750. And it says, on what dates do you need to make a third payment to avoid interest being levied? In addition, state whether each should submit a third provisional tax payment. Now, third provisionals are very, very straightforward, guys. It basically says, how much have I not paid yet? And I need to pay it for a company within 6 months of year end. So look what the question says. The question says, my actual 750, so tax payable, 202,500. The question said, my first payment was 100. My second payment was 75. How much does my third payment need to be? So the way that it works is like this, guys. Because it's got a December year end, what you'll do is, after 6 months, in June, you will make your first payment. At December, you will make your second payment. And then 6 months after year end, you will make your third payment in June. So what do you need to do? You need to pay at least 27,500 as a third provisional tax payment. There are no penalties, guys. But what SARS says is, if you don't pay it within 6 months of year end for a company, I'm going to start charging you interest. So basically, this is when the interest starts. So if you don't pay your third payment within 6 months of year end, that's when it's going to happen. Okay, let's have a look for Marius Burnett now. What does the question say with Marius? It says, for Marius, taxable income's 1250. He made a first provisional of 200 and a second provisional of 314. Assume he does not belong to a medical aid. So what are we going to do with Marius? We're going to say actual 1250. Tax per tables 412. Less rebates. Less your first and your second provisional tax payments. Guys, you end up with a minus. So you don't have to make a third payment. You don't do third. Why? Because you've overpaid already. And what will happen is SARS will give you interest received from when the third provisional tax payment needs to take place. But I just want to discuss when a third provisional tax payment takes place for an individual. So the first payment for an individual is on 31st to the 8th, 2025. Second one will be at year end. Now what they do with the third payment, guys, is your first payment for next year is on 31st of the 8th, 2027. And what they say is we can't do all the admin properly at the same time. So only if you're an individual, your third payment needs to be done by 7 months after year end. That's when the third payment is for a natural person. Because they can't handle all the admin. They can't do the first and the third payments on the same day. So your third payment, if you're an individual, 7 months after year end. Your third payments, if you're a company, is 6 months after year end. So that's if they ask you to do a third provisional tax payment. Okay. So that's what you just need to understand. Okay. Let's carry on for topic That's what's going to happen if they ask you to do a third payment. What haven't I paid yet? It says further information for task 4. You received the following email from Marius Burnett. Subject, need help understanding provisional tax. Dear tax practitioner, I hope you well. It's Marius Burnett again. You may remember me from our previous correspondence about whether I needed to make a third payment. I've always taken the bold step of managing my own tax affairs, but I'm feeling I do not understand how much I need to pay for my second provisional tax payment. Clearly, I got it wrong with the amounts of my second provisional tax payment because he overpaid 119,000 Rand. I based my second provisional tax payments on 1.5 million earnings from my plumbing practice. I had no other income. Tax per tables was 514,519, and I paid 314 as I'd already paid 200 in my first payment. Okay, and it says in the required, it says my girlfriend told me I should have taken into account my monthly medical aid of 3,000 per month and 7,500 in medical expenses that were not paid by medical aid into my account. And silly me, I forgot to remove the rebate when I paid it. So task 4 says calculate the minimum amount that needs to be withheld for the second payment for Marius Burnett in order to avoid penalties and send it to him. Base your calculations on an estimated taxable income of 1.5 million. No discussion is necessary as you will meet with him to discuss it. So guys, watch what happens. Okay. Guys, his income is 1.5 million. And what did we learn? We said that when something is greater than 1 million, we use 80%. So what's going to happen, guys? We're not going to use 1.5 million, which is his estimate. We're going to use 80% of 1.5 million, which is 1.2 million. What are we then going to do? We're going to say tax on the tables for 1.2, 391. Less your rebates, less your medical tax credits. But remember here, because he is under 65, guys, when you do the estimate, you're going to, sorry, this should be 4 times, sorry. And it is calculated 4 times, by the way. You can see 4,368 times 4. Guys, and less 7.5% because he's under 65. You're going to do the medical tax calc as if you were under 65. Leaves you with 369, less your first provisional tax payment was 200. Means your second provisional tax payment needs to be 169,916. And that is based on your 1.5 million times 80% estimate that you use. So guys, let's unpack where we are. What are the questions that we can get? Do I need to register? Okay. What did I tell you to do? Am I above the threshold? Do I earn more than 30,000 Rand? That's not employees tax. Second question, calculate your first payment. What are you going to do if it's a first payment? Basic amount times half, and you're going to work out how much you need to pay in. Second payment, what are you going to do? You're going to say, is my actual income more than 1 million or less than 1 million? If it's less than 1 million, I'm going to base it on lesser of basic amount or 90% of actual. If it's more than 1 million, 80% I'm going to use, like in this example. And what am I going to do for my third payment? I'm going to say, how much haven't I paid yet? What's my actual? Less. First, second payments. This is how much I still need to pay, and there's my third one. Okay, so those are the different payments. So what I would want you to take out of this example is, do I know when to register? Do I know how to do a first calc? Do I know how to do a second calc? And there are 2 types of second calcs. Below second calc, below 1 million and above 1 million. Third calc is just a catch up. And then the fourth one is penalties are part of your syllabus. So I'm going to show you what happens if you don't pay enough. So further information for task 5. It says in the 2025 year of assessment, Melissa Burnett earned 412,769 from a teaching job and her investment portfolio. She was assessed on 6 July 2025. Melissa Burdett, registered as a provisional taxpayer. She turned 20,000 a month for taking care of her mother. She made a first provisional tax payment of 8675 and a second provisional tax payment of 40,000 on 5 March 2026. Now, guys, when do you need to make your second payment by? When do you need to make your second payment by? End of Feb, 28 Feb. So guys, the first thing I want to teach you is that there's a 10% late payment penalty. So she paid 40 grand late. So how much is your late payment penalty going to be? Guys, 10% penalty for late payment, 4,000. Plus, I need to pay interest. So normally we'll give you the interest in a question. And what's your interest going to be? 40,000 plus the 4,000 penalty times by the interest rate. And I paid it 4 days late. So I'm going to have to pay 49.42 in interest as well. So guys, late payment penalty, 10%. So I'm just teaching you that. Not only is there a late payment penalty, there's a 20% underestimate penalty. Okay? So let me show you how the underestimate penalty works. So as far as the underestimate penalty is concerned, what we're going to do is we're going to say she's completed her tax return and she earned taxable income of 478 during the year. She's not a member of a medical aid fund and has not kept any medical expenses. So guys, we're going to say that is less than 1 million. So for purposes of the penalty, guys, we can either use the basic amount or 90% of actual. Okay. How much is my basic amount? My basic amount is 412,769 because she was assessed on 6 July 2025. What is my actual? My actual is 478,652, this one. But for purposes of penalties, I only needed to pay 90% of that. Okay, so have a look here at the solution. It says basic amount 412,769, 90% of actual 437.87. I can use the lower of the two, 412,769. Tax per tables and everything. 90 less your rebates, less your first provisional payment. Why have I not put my second provisional payment in there? Because she submitted a return 4 days late. So hypothetically, at the deadline date, she has not submitted it yet. Now, for the 4862 guys, in your additional questions, you will see that there's one of the questions is a penalty calc like this. But they say you submitted your return on the 25th of Feb, but you only paid it like on the 10th of March. For that question, because you'd submitted your return on time, you can put something into the second provisional tax payment. You've got the late payment penalty, but at least you submitted your return. In this example, you hadn't submitted your return yet. So at 28 Feb, there's a 0 second provisional tax payment. That's why there's 0. And I wanted to do 2 types of questions so that you can see how to do it for an exam. So guys, no second provisional tax payment. That means that we've underpaid 64,555. And how does the underestimate penalty work? It says your underestimate penalty is 20% of that amount that you've underpaid. So that's how the underestimate penalty works. 20% of whatever you've short paid. However, guys, what they do is inside the Act, it says, we are not going to double penalize you on the late payment as well as on the underestimate. So if you made a late payment, whatever you paid for the late payment penalty, you can take off your underestimate penalty. So like for the 4862 guys in your additional questions, you will see that the late payment penalty is bigger than the underestimate penalty, and you didn't have to pay any underestimate penalty in. So you need to remember your late payment penalty is taken off this one. So guys, essentially, what are the questions for provisional tax? It is, do I need to register, or calculate first, or calculate second, or third, or calculate the late payment penalty, or calculate the underestimate penalty. And what I've done in this case study is I've given you one of each type of calculation. So I find that people really, really struggle with provisional tax. So I've just tried to give you one of each type of calculation. So this is like your provisional tax masterclass. Okay, and I find students really, really struggle with this. So I'm just basically showing you how to actually do this. So I just wanted you guys to understand how this works. Okay, here's your masterclass. There should be no other provisional tax questions you need to do. Let me just again say something to you. You can pay whatever it is that you like. So they can never ask you a question that says, what is your second provisional tax payment? Because you can pay nothing and pay the penalties, or you can pay more and not pay the penalties. It's up to you as to what you want to actually do. Okay, but what we can do in a question is we can say, do I need to register? What is the minimum first payment so that I don't have to pay a penalty? What is the minimum second payment so I don't need to pay a penalty? How much should I top up with my third payment? And if I paid late, how much is my late payment penalty? And if I didn't pay enough, how much is my underestimate penalty? So those are the questions. So please use this as a case study and use this to answer provisional tax questions. Cool. Any questions? Guys? So this is your go-to thing. If I was learning provisional tax, I would learn off this example. Okay, cool. Okay, just remember, I think in the year-end exam for 4862, I think it was a 15-mark question on for your second payment. Calculate the second payment. I can't remember whether there was a penalty or not. So that's there. Okay, dogs. So no questions. Let me move on to the next one. Okay, I'll be so. So let's move on to the second one. So the board question. Let's go on to the board question itself. So guys, this is the 2026 January tax question. So we're just going to go through it. I'm not going to do the second part of the question, the third part, sorry, which is in the required this. It says, discuss whether Hebony should withhold employees tax on the 121,500 payable by Creative Lexi. Guys, you're not required to know how to do personal service providers. Okay, we do personal service providers as part of topic 5. Okay, but what I've done is I've given you the entire question so that once we do topic 5, you can see what's going to happen with a personal service provider. It's not examinable for topic 4. But guys, this is what's happened in the board exam. What happens is there's a 27-mark number crunch. There was a 6-mark employees tax question. And then there was gross income for 7 marks. So there was gross income for 7 marks. Okay, so we're going to go through and we're going to do this. And what I'm going to do is I'm just going to read through the question. I'm going to do the solution with you just to give you an idea. But before we do this question, what I'm going to do is I've given you a little bit of a consideration thing. So what I basically said is if I was doing an individual's question, a number crunch in an exam, there are a couple of things that I would be incredibly aware of. Okay, so the first thing that I would be aware of is what is the age of the taxpayer? Are you over 65 or you're under 65? Why is that important? Because if you are under 65, you get 17,235 as a rebate. You also get an interest exemption of 23,800. You also get medical tax credits where you times by 4 and you times by 25%. And if you don't know, you need to actually just make sure. If you are over 65, and guys, the Act doesn't say over 65, it says will be 65 on the last day of the year of assessment. So guys, I'm going to make a flippant comment to you, but you'll see. And if you look at board exam questions and stuff like that, the most popular age to die in a tax question is age 64, but you would have been 65 on the last day of the year of assessment. So often in a question, they say his birthday is the 10th of January. Okay, but he died on 31 December, 10 days before his 65th birthday. Guys, if someone dies but would have been 65 on the last day of the year, you get the 34,500 interest exemption, obviously times by the number of days. If you die, you're not alive for the whole year. So you need to apportion the interest exemption because you apportion it if you don't have it for the whole year. The second thing is you will apportion your rebates. Okay, you will apportion your rebates as well. Okay, so please be aware. If you would have been 65 on the last day of the year, you get the NAS medical tax credits, the times 3, and you also get the times 33.3%. You get the 34,500 Rand interest exemption, and your rebates, you're going to get the 17,235 plus the 9,444. Even if you never ever got to 65, because you would have been 65 on the last day of the year of assessment, then you get both rebates. Okay. If you look in 10(1)(I) for interest, it says if you would have been 65 on the last day of the year of assessment. If you look at section 5 and 6, where you've got the rebates, it says if you would have been 65 on the last day of the year of assessment. So guys, as I said, 65, 64 is the ideal age to die in an exam. If you go through old board questions, every single one of them, the guys died at age 64. But they expect you to know that you would have been 65. The next thing that I would do as part of a question is, I would say, are you married in community or out of community of property? So guys, please just remember, this is what I call a FUBAR thing. If you get this wrong, it's FUBAR, fuck up beyond all recognition. Okay, please just remember the FUBAR. I know it's a bit rude, but you'll remember it. Guys, if you're in community of property, you need to split dividends, foreign dividends, rent, interest, and capital gains. Okay, so if you're married in community, remember to split all of those items. You don't have to split if it says it's outside of the community of property. Let me explain how that would happen in an exam question. It can say Mr. and Mrs. A were married in community, but when his mother died, because she hated his wife, she insisted that any of the inheritances would not form part of the in-community of property. So if that is the case, you will split everything else, but whatever the mother gave to him, you won't split because in the will, it says it's not part of the in-community of property. Okay, so in a question, guys, if you're married in community, you split interest, dividends, foreign dividends, rent, and capital gains, unless it says in a will or in a donation, someone had specified it wasn't to be part of the in-community of property. Now, guys, if you get that wrong, it's a lot of marks that you're going to lose because you're going to get all the interest wrong. You're going to get all the exemptions wrong. You're going to get everything wrong. So that's very, very important for you to do. The next one, guys, natural persons. I need you to understand that when you look at a question, you need to ask, is your salary bigger than your commission? If your salary is bigger than your commission, Section 23M of the Act limits the deductions that you can get. And I'm going to apply this to the board question now. So if your salary is bigger than your commission, what does 23M say? It says you can get wear and tear. It says you can get bad debts if your boss doesn't pay you. You can get doubtful debts if you're not sure if your boss is going to pay you. You can get 11C legal expenses if you want to sue your boss. And then if you refund your salary or you refund your restraint of trade, you can take it off as well. That's what 23M allows you to take off. You can't take off anything else. So essentially 23M says, I don't get deductions. I get pension, I get donations, but I don't get anything else really. If your commission is bigger than your salary, you can get deductions for whatever expenses you earned earning commission. So if you take out a client for lunch, you can get a deduction. Okay? You can get a deduction for travel to your clients to earn your commission. So if your commission's bigger than your salary, you're allowed deductions. And then guys, if you're carrying on a separate trade, you do a calculation like a company. It's a little bit like what we did with you on Thursday last week. There was a separate trade in there. He traded selling his own watches. So that you treated like a company. And when he was employed, Section 23M limited the deductions that you could claim. Okay? So last week's question, the one that Constance did with you, had a separate trade in it and it had a salary greater than commission in it. So you could see you did your salary normally and your trade you treated like a company as part of that question. Now that was the 2025 January board question. So in the 2025 January board question, they gave you salary and they also gave you a separate trade. Very, very similar to what you did on Thursday. This question, okay, is you need to understand which one of the three it is. The other thing that you need to do, guys, is you need to make sure you get your order of deductions right. First thing happens is income, exempt income, deductions, and assessed losses in whatever order you like. Guys, it doesn't need to be in a specific order as long as those are combined together. I just want to point out, guys, for companies, assessed losses go at the bottom for a company. For an individual, assessed losses go up at the top. That new rule for assessed losses for a company, it does not apply to individuals. So assessed losses go in a different place for individuals as compared to a company. Okay? What happens, guys, is the next thing that happens is allowances need to go in. Guys, now I need you to understand something. Guys, if you look at section 8 of the SACA legislation handbook, it says there shall be included in taxable income travel allowances, subsistence allowances, etc. Because it says there shall be included in taxable income, you need to put your allowances, your travel allowance and your subsistence allowance after income, exempt income, deductions or assessed losses. CGT, if you look at the charging section for CGT, it says there shall be included in taxable income. It doesn't say gross income, it says taxable income. That's why CGT goes after income, exempt income, deductions, etc. Guys, you need to do it in the right order. Now, I'm busy marking the TAX48612 class test that you did for test 2. You have to do CGT after everything else. And guys, there was 1 mark allocated for putting CGT into the right place. You needed to put it in before donations. So for all of you that put, and there are lots of you, that put donations in before CGT, you lost 2 marks because you lost 1 mark for putting donations in the wrong place. You lost 1 mark for putting CGT in the wrong place. You need to make sure you do things in the right order. Now, most of the questions that you'll see, there's a format mark for doing this in the right order. So you'll see that there's normally a bonus mark in any individual question for layouts and structure. Get the 1 mark for putting things in the right order. And I'm just giving you a little bit of a heads up for putting things in the right order. Because if you don't put them in the right order, you're going to get into trouble. The other thing that I just want to say, and it's not inside here, guys, when you're doing an individual's question, I would set it up like this. Have an income or expenses column, have a lump sum column. I like to have a CGT column because I think that you're going to just do all your CGT calcs immediately, but you need to add it up in the right place. And then you can have your details over here. So this is the way I would set out a question. We will see the board solution and we'll see how they set it out as well. So let's carry on. So it says Lexi Liebenberg, 27 years old. Fantastic. So she's under 65. Okay. Is a South African tax resident. Okay. Her public profile began to grow during her school years through modeling and fitness instruction. Because she's an SA tax resident, remember we get taxed on worldwide income. Guys, if it said she was a non-resident, you'd only get taxed on source. It says she achieved national recognition as a finalist of the reality television show Real Students of Cape Town that allowed her to study and complete a certificate in management at a London-based business school. While studying in the United Kingdom, she wrote a motivational book entitled Empowering Voices from Margins to Spotlight. This book inspired young women from disadvantaged backgrounds to overcome personal challenges. TB Sprong, a leading UK publishing house, published the book, which had promising sales. After returning to South Africa, Lexi started working at Hebony, Pty Limited, a leading advertising agency and an SA tax resident. Lexi joined Hebony's corporate communications department and played a key role in internal and external brand messaging initiatives. Lexi's employment contract permits external work to the extent it does not interfere with her contractual employment obligations. Driven by an interest in digital influence and social media, Lexi began to explore opportunities as a content creator. She taught herself using online resources and now has 150,000 followers on social media platforms such as Instagram and TikTok. In addition to her social media presence, she is a motivational speaker at events for which she's paid a fee. Lexi met Arno Smith at a conference 2 years ago, and the pair have been dating since then. Arno is a CASA and an associate director at a large audit firm responsible for managing several large audit clients. He is Lexi's top follower on her social media platforms and actively promotes her professional profile. So none of that stuff has got any tax calc in it. Now, guys, individuals' questions are really, really straightforward. And let me just explain why. Everything is there in front of you. So as long as you can read properly, you can get marks. Okay? So the whole key to getting an individual's question right is to just read properly. That's all you need to do. So it says here, the following information relates to Lexi's employment with Hebony for the period 1 March to 30 November. So guys, she only worked for 9 months there. It says Lexi received a basic salary of 50,000 Rand per month. So think about what you are going to put into the solution. Salary of 50,000 per month, she worked for 9 months. So guys, we're just going to go through the board solution now. 1 mark, 50,000 times 9 months, 450,000. You get 1 mark for doing that. Everything's in front of you. And remember, this is a board question. I'm doing a board question with you. It says Hebony contributes 14.8% of basic salary to Hebony's Provident Fund and an improved retirement fund. Lexi does not have any additional contributions to the fund. So guys, because there's a 14.8% here, what I need you to do is I need you to remind yourself that you need to come back later. So somehow you need to remind yourself that I've got to come back and do a section 11F later. But what can I do with the 14.8%, guys? I can say 0.148 times by her salary, which was 50,000 times 9, 450,000. The company gave me 66,600 rands worth of contributions to a pension fund. So I'm just going to write this down, 66,600. Right, and what am I going to be able to do in my solution? Fringe benefit to a provident fund, 450,000 times 14.8%, 66,600. Okay. And I did a P there. So why is there a P there? If you got the 450 wrong, they will mark the error through into the second calculation. Because if you got that wrong, they will carry it forward into the second calculation itself. Next one. It says Lexi contributes 4,000 per month to the Recover Medical Aid Fund. The medical cover for herself and is the main member, and her mother is a dependent member. So guys, this is for my 6A tax credit. Okay, and we're not going to do it now, we're going to do it later. Because it says Hebony does not make additional contributions towards Lexi's monthly medical aid. So what I would do in the solution, guys, but they didn't do it in the board exam, is I would put a line item in to say no medical fringe benefit, but they didn't do it as part of the board question. That's why I can't show you anything there. But to cover my backside, I would put a no in there just to cover my backside. It says 2.3. Lexi had the right of use of a laptop purchased by Hebony on 15 September for the full 9 months, and they used the laptop only for business purposes. Now, guys, inside the required, what it does is it says provide reasons for amounts that have no effects on the calculation. And it also says for purposes of answering required B, assume that, okay, the foreign income is fully taxable in South Africa and section 6B is nil. So they've said whenever we're going to put a nil in a calculation, you need to put a reason down. So let's go back here. And what does it say? It says she's got right of a laptop for 9 months and only used the laptop for business purposes. So what are you going to do as part of the solution? You're going to say, listen, it's a no fringe benefit, but the mark is not for writing the no down. Okay? Now, guys, there are two points that I just want to make across here. Guys, if you put no fringe benefit, you will not get a mark. It's not that there's no fringe benefit here. It's that there is a no fringe benefit. And I'm talking about discussion questions because sometimes you get discussion questions. Don't say that there's no fringe benefit because there is one. It's just valued at nil. So I need you to get into your heads that when they give you something and it's got zero value, it's a no fringe benefit for your discussion question. So please just do that. This is not a discussion question, but you can see in the board solution, it says nil. If you said no fringe benefit, you won't get marks, but you don't get the mark for the nil, you get the mark for the reason. So you're going to say, the laptop's got a nil value because I use it for business purposes. So anytime you use something more than 50% for business purposes, it's got a nil value attached onto it. They treat it as incidental use. Okay, so guys, that's what you're going to do for the laptop. Next thing, it says she received a monthly cell phone allowance of 1,000 as Lexi is required to use her phone for business purposes. Lexi's cell phone bills for the 9 months amounted to 15,722, of which 7,413 was for personal use and 8,309 was for business use. So the first thing that's going to happen is I'm going to have to include 1,000 times 9 into my solution. Okay, so what's going to happen is there's the 9,000. I've got 9,000 rands worth of cash. Okay, can I take off the expenses? Now remember what I did with you, guys. Remember what I did with you. I said, if your salary is bigger than commission, there's no commission here. She just gets a salary. Section 23M limits deductions. So you can get your 11F, you can get for pension and retirement funds, you can get your donations right off, but you can't get for cell phone expenses. So what's going to happen inside the question? They've got this whole thing here that there's expenses, 15,722 and 8,309 was for business use. Tough shit. Because your salary is bigger than your commission, you cannot get that as a deduction. But you need to write something down to explain it to them. So have a look there, guys. It says no deduction because she's not mainly a commission earning employee to a section 23M. Okay, so there's no deduction for cell phones there. So please just understand, you have to look to see whether your salary is bigger than commission, or in this case, there's no commission. And then your deductions are limited. You cannot claim those deductions themselves. So there it is inside the solution itself. No deduction, section 23M. Guys, next thing. It says, in terms of leave policy, rules of Hebony, a maximum of 10 days leave may be carried forward to the next period and any balance must be paid out. On 28 Feb 2025, Lexi had leave paid due of 35. The amount was paid on 25 March 2025. So guys, on 28 Feb, that's last year it was owed to you. Now guys, you need to understand any variable payments. If there's a variable payment like leave pay or overtime, okay, Section 7B of the Act applies. And how does Section 7B work? It says that you only get taxed when it is paid. So any variable payments, if you see leave pay, if you see overtime, if you see a bonus, any variable payment like that, it goes into the year when it was paid. And it says it was paid on 25 March 2025. That's why inside the solution, it goes into this year's taxable income. Even though it relates to last year, it was only paid this year. And because it's only paid this year, it goes into this year's taxable income calculation. And again, this is a board question. This is at high level. If you can do this and you can understand this, you should be fine. It says, Hebony has a canteen on its premises that provides meals and refreshments exclusively for employees. Hebony credits all employees access cards with 400 Rand per month, which they may use to purchase meals, snacks and refreshments. Lexi never spend more than her allowed 400 Rand per month. All employees are not allowed to withdraw any unused amounts. Sorry, guys, I didn't open it up. Let me just open it up. Guys, so this was the one that I gave you yesterday. And inside yesterday's one, there's you've got all your fringe benefits in there. Sorry, just let me get to meals. There's meals. It says provided at work, during work or extended hours, no fringe benefit. So anything that you give at work, there's no fringe benefit. That's why for this meal one here, what's going to be in the solution? Again, nil. And what are you going to say? If you get given meals at work, it has a nil fringe benefit attached onto it. And that's what you're going to include. Next one. It says on 3 Jan, Hebony provided Lexi with an interest-free loan of 20,000 to undertake a short online course in personal investments. The course is aimed at individual investors not relevant to responsibilities. Over the duration of the loan, the repurchase rate was 6% per annum, and the prime rate was 10.75. No principal repayments or additional borrowings were made after 3 Jan. The outstanding loan of 20,000 was paid off against Lexi's final salary payment. So a couple of comments, guys. Number one, there are 2 loans that do not attract fringe benefit interest. The 2 loans that do not attract fringe benefit interest are if there's a loan of less than 3,000 Rand. So in an exam question, if the loan is for less than 3,000 Rand, no fringe benefit. The second one is a study loan to study. If you give an employee a study loan, there is no fringe benefit on it. So for this one, yes, I understand that they're giving you interest rates, but you do not need to calculate low interest loans. I want to ask you as well, repurchase rate 6, prime rate 10.75. If this wasn't a study loan, which one would you use? What percentage would you use? Can you just put it in the chat? What percent you think you would use to do your fringe benefit calc? Okay. Mark Charles Nyango, you are correct. you will use the repo rate plus 1. So guys, they can either give you the official interest rate. What is the official interest rate? Repo rate plus 1. So because they use repurchase rate, 6% here, you need to understand that repo plus 1 equals official rate. Okay. So guys, your official rate is repo plus 1. You would have used 7% in this question. Okay. But you don't need to use 7%. So what I just want to do is let's go look at the solution. Guys, can you see interest-free loan? It's a null value because it enables her to further her studies. But here's the next thing, guys, and this is the really important thing. They said the outstanding loan amount was set off against Lexi's final salary. So she repaid the loan amount. Is there any tax effect when you repay a loan amount? No. But guys, if they put it into a question, inevitably it's going to be in the solution. So can you see it says no deduction for the settlement of the loan. It doesn't have a tax effect. So if they write something down inside a question, they want you to comment on it. So they say you repaid the loan. You need to sit there and say repayment of loan, no tax effect. It's a settlement of a debt. Okay. Or section 23M prohibits any deduction. They've got 3 things that you've got there. Okay. So if it's written in the question, please try put it in the solution. Next one. It says, as required by law, Lexi correctly contributed 177.12 to the UIF. Guys, can you get a UIF deduction? Now it's in the question. They want you to write something down. So because they want you to write something down, what is going to happen? In the board solution, there's UIF. No deduction. UIF is not a deduction for tax purposes. It does not constitute a deduction. There it is. No. So guys, if it is there in front of you, write it down. Now, most people in an exam will not write the settlement of the loan in the solution. They'll not write the UIF because they know that it's not part of your tax calc. You get a mark for telling the examiner it's not part of your tax calc. So if they tell you about it, you write something about it while you actually are doing a question. Okay, that is a mistake that so many people make. If it's in the question, do something in your solution. It says, Hebony seconded Lexi to Hello Media PLC, a company based in the UK. Lexi departed on 30 May and landed in the UK on 1 June. She returned on 30 August. So June, July, August, it's plus minus 90 days. Okay. It says, the purpose of the secondment was for Lexi to assist with the new product launch by one of Hello Media's major customers, Lola Cluster Lashes. Hebony continued to pay Lexi a monthly salary during her secondment to the UK, and Hebony withheld PAYE during the secondment period. She received no subsistence allowance. Now, guys, here is what happens. You need to write something down. So what they've done in the solution is this. It's right up at the top. So the second line item, it says exemption secondment to the UK. It says Section 10102 is not going to apply. Now remember, what does Section 10102 say? It says if you are overseas for more than 183 days and you earn remuneration and you spend at least 60 consecutive days overseas and you do not work for the SA government, then you can get 1.25 million tax-free if those 4 requirements are there. Because she's only overseas for 90 days, which is less than the 183, there is a mark in the board solution for saying Section 10102 does not apply. So again, it's written in the question. You need to write down that she doesn't get a Section 10102 to get the mark. Look how many marks there are for null amounts inside here. 1, 2, 3, 4, 5, 6, 7 so far. And remember, this question's only out of 27. Every time something does not have a tax effect, you need to write something down. And having marked papers for the last 30 years, I can tell you that lots of students, if it doesn't have a tax effect, you don't put it in your solution. It is absolutely imperative that all of the null stuff gets put in your solution, because we can only give you a mark if you write something down. If you don't write something down, we can't give you a mark. Okay, so let me just give you an example from test 2. What happened in test 2 is, for TAX48612, there was VAT that we didn't include inside your cost of your asset. You needed to write something down to say, VAT we don't include in the cost of the asset. Otherwise, you can't get a mark, traditionally. Something's got to be put down. We can't sit there and say, you didn't put anything in the solution, therefore you knew VAT wasn't supposed to be there. We can't make that assumption for you. So whenever something doesn't go into a calc, tell us it doesn't go into a calc. You will inevitably get a mark for telling us that. So that's very, very important for you just to bear in mind. Next one. It says, Lexi resigned from her employment from Hebony on the last working day was 30 November. Thus, from 1 September, she was free to pursue other projects. She withdrew the full amount of the savings component from her provident fund, amounting to 35,936. So guys, savings component, where does it go? A savings component is going to go into your, sorry, next page. It's going to go into your income column. You guys comfortable with that? So anything that goes out of your savings component goes into your income column. In the question, can you see it says she also withdrew the full amount of her vested components amounting to 331036. Now, vested component goes into your lump sum calc. So guys, here's the other column. And there's your lump sum calculation, the 331036. There's your lump sum calculation. And guys, remember, if you're taking something out of your vested amount, she is only 27, I think it was in the question. So which table are we going to get taxed on? We are going to get taxed on the withdrawal tax table here, because this question asks you to calculate tax payable. So you're going to go, there's the 27,500. It's on the withdrawal tax table, not on the retirement tax table. So when you take stuff out of your vested amount, traditionally, if you're not of retirement age, it goes in as a withdrawal lump sum. So there it is. And then, guys, looking at the question, the next thing it does, it says, transferred the retirement component to a provident preservation fund. Remember, when you transfer from one fund to another, what are you required to do? You can see inside the question, there's no tax effect. Because when you transfer from one component to another, it's tax-free. So can you see it says transfer to the preservation fund, no tax effect. Again, there's another mark there for a null. Okay, and then there's another null for 6 quad rebate, which we'll do just now. So like almost half the marks of this question are for putting nulls into the solution. Okay, so that's there. Next one. Guys, so this is kind of like what you need to do. You need to remember savings component, income. Vested component, lump sum. Retirement component, can't take it. Okay, goes to a provident preservation fund, that's a null. Next one, guys. It says Lexi received the following additional income during the 2026 tax year. Lexi earned 10,000 before tax from product endorsements as a social media influencer. Guys, she's earning 10,000 as an influencer. What are we going to do with the 10,000? Sorry, go back up there. 10,000 goes into your income. Carrying on a trade, earns 10,000 Rand, goes into her income. Next. It says Lexi lives in a 2-bedroom apartment in Bryanston, a suburb of Joburg. Her monthly rent is $6,000, which she pays in cash. Due to the low rental amount, her landlord does not provide her with supporting documents. She converted one of the bedrooms, approximately 12 square meters, into a recording studio. The entire apartment is 80 square meters in size. So guys, can you claim for a home study? I want you guys to think about it. Can you claim for a home study? They've told you your rent is 6,000 Rand a month. They've told you that 12 out of 80 square meters she uses as a home study. It says the landlord does not provide supporting documents. What are you going to put into the solution? And you'll say, no deduction. Why? Because I don't have supporting documents. I am not allowed to claim if I do not have supporting documents. So there's another null. That's the 11th null in the solution. Okay? No deduction. I don't have supporting documents. If you did have supporting documents, you'd be able to claim 12 over 80 times 6,000 times 9 months. Because for 9 months, you used it as a home office. But because there's no supporting documents, can't claim it. Carrying on. It says Lexi was Master of Ceremonies at a spring fashion show that was held at Cape Town Convention Centre on 1 September 2024. As payment for her services, Lexi received an all-expenses paid trip for Cape Town for a weekend. The market value of the trip's 20,000. Trip was non-transferable and had to be used within 6 months. Lexi and Anna took the trip in February 2026. So guys, she was Master of Ceremonies and they gave her 20,000 Rand trip for being Master of Ceremonies. What are you going to do? You're going to put the 20,000 Rand into your gross income. Why? Because it's for services rendered. She was Master of Ceremonies. Paragraph C of the gross income definition. It's going to be included into your gross income. Next one. It says, while on secondment to the UK, she received 3,000 for attending and giving a talk on her book on 20 August 2025. The UK did not apply any withholding tax. So guys, there's going to be 2 lines in the solution. One for the 3,000, one for the withholding tax. Okay, but what rates are we going to use? So here it says they give us an average exchange rate, and they also give us a spot rate in the solution. So what I'd like to do here is I just want to unpack what we're going to do. So guys, for section 25D of the Act, that's what you did in the last thing. For a company, you're required to use spot. For a natural person, guys, what you're allowed to use is spot or average. You've got a choice. Now, let me just explain how you're going to do this in an exam question. Okay, guys, if it is income, you're going to use the lower of spot or average. Why? Because you want to make your income as small as possible. If this is an expense, you want to make your expense as big as possible. So you'll use the greater of spot or average. So in this question, should we use the 2343 or the 2351? Which one? This is income from her book. So you want to make your income as small as possible. So which one of the two are you going to use? The lower of the two, the 2343. So in the board solution, guys, they use the 2343. So whenever you've got foreign income, guys, ask yourself, is it income or is it an expense? If it is income, choose the lower rate. If it is an expense, choose the bigger rate, because you want a bigger deduction and a smaller income. So that's how you do it for foreign amounts, and that's why they always give you a spot and an average rate in an exam question. Okay, so that's just there. Guys, and then what have they got? Less the section 11F deduction, I'm not doing the 11F deduction. You guys know how to set this out properly. Okay, and then there's lovely marks, guys. Normal tax calc. I just want to point out something. Guys, you must write this out. You've got a taxable income of 633,886. Write out the calc because there is a principal mark there. Is that all right? Write it out because there's a principal mark there. Okay. Primary rebate, 6A rebate, and they told you not to do the 6B rebate. Now, guys, remember in the question, it said that there was no withholding tax on the book income. That is why they've said the 6-quart rebate is null. Because in the question, it said there is no foreign withholding taxes. So you can't get a 6-quart rebate for any withholding tax. That's why they've put it in the solution. So I just wanted to put this out to you. So guys, let's just unpack one or two things. Okay, this is the board question. Okay, I don't think it's that hard. Okay, if I had to unpack what's happening in the 2025 board, January, there was an individual's question out of, I think, 21 marks, I think. Okay. In the 2026 January question, there was this one out of 27 marks. So guys, they like asking individual questions like this in your exams. So I would assume that at some stage, either in test 3 or in your year-end exam, you're going to get, or maybe even in both, at some stage, you need to get an individual tax calc for, what, 20 or 30 marks. So you need to know how to do questions like this. It's very, very important. People seem to think that this is postgrad. You need to actually, you're going to get asked questions that are going to absolutely kill you. No, you're not going to get questions that are going to kill you. This is not hard. To do an individual question properly, you just need to read properly and get it done. Okay? And I just need to remind you, this is 11F, and then there's a medical thing. Remember what I did with you in the question. I went and I said 11F there, 6A tax credit there. You need to make sure that you mark off what you need to do right at the end of the question, the 11F and the 6A tax credit. And if you mark it off while you're doing your paper, you'll just remind yourself to go back and do the 11F and the 6A tax credit itself. The question said you didn't need to do a 6B tax credit. That's why it's not done in the solution. So this gives you a little bit of an example. So guys, if you 4861, I want you to, you can go quite soon, but I just want to actually just discuss concepts with you. If you 4861 or 4862, you can get someone that does in a question. You can get someone that does, okay? If you 4861, you're not going to get the state calculation, so the estate, or an estate duty calculation. That's what it's excluded from your syllabus. But you can still get a human being that dies. So let's just unpack what's going to happen if you get a human being that dies. If a human being dies in a question, how's this going to impact upon you? Your primary rebate, you will apportion on a day's basis if someone dies. Your interest exemption, you'll apportion on a day's basis if someone dies. Your 6A rebate, it's not going to be times 12, it might be times 9 or times 10 or whatever. It depends on how many months the person was alive for. So guys, whether you 4861 or 4862, if someone were to die, just remember the rebates are apportioned, the interest exemption is apportioned, the 6A rebates, the medical tax credits, you only do it for the months that you were alive. Just make sure that you actually physically understand that. And that's important for you guys to understand. Okay, so that's what's going to happen. At the back of the handwritten notes for today, I have put in an illustrative example of what happens if someone dies. And I'm going to deal with income and I'm also going to deal with CGT. Now, guys, if you 4861, you can still get what happens up until the date of death. So let's just make sure we understand how that works. It says the following amounts are received by the executor after Mr. A, 70 years old, died on 14 May of the current year. 3,000 interest up until the date of the death and 5,000 after the date of the death. So guys, how does the sections work? It says if you earn something up until the day that you die, it goes into your tax return. So the 3,000 goes into the dead guy's tax return. The 5,000 interest received after the date of death. For 4861, you won't get this in an exam, but if you 4862, we can ask you to do the estate tax calc. And what will happen in the estate tax calc is the executor will include the 5,000 after the date of death into the executor's tax calc. So that's what happens. The next one that I've got there, local dividends of 30,000 declared on 1 May to shareholders registered on 12 May, paid on 31 May. I want to ask you, if the guy dies on 14 May, do you put that into the dead guy's tax return or do you put that into the executor's tax return? Now, guys, remember, we use gross income definition. So gross income definition says, when do you include something is the earlier of receipt or accrual. So remember, you have received it on 31 May, but when are you unconditionally entitled to receive something? Have a look at that and tell me what your unconditional entitlement date is. Which one? No. You have to be in the register. So for dividends, it's when you have to be in the register. So your entitlement date is actually 12 May. So most of you got that right in the chat. So guys, because it's 12 May and the guy died on 14 May, you will include it into the dead guy's tax return. The dividend will be included into the dead guy's tax return. Why? Because he was entitled to it before he died. It doesn't matter that it was paid after he died. We do gross income on earlier of receipt or accrual. He was entitled on 12 May, therefore it goes into his return. So that's how you'll deal with income before the date of death. I've now got CGT assets. So I just want to do a diagram for you. So guys, if you had to do a timeline, and this is when someone dies, what happens is the deceased is deemed to sell everything at market value to the executor, except if it's going to go to the wife. If it goes to the wife, guys, it goes at base cost. You step into the shoes of your spouse. So the deceased is deemed to sell everything at market value to the executor. So that's what this example is for. Let's just go through it. It says Mr. A died and left the following assets. Holiday home with a base cost of 200,000 that had a market value of 600,000 at the date of death. So in the solution, guys, what are you going to do? You're going to say, I'm deemed to sell it at market value on the date of death. There's my proceeds of 600. And my base cost is 200,000. Okay, so I'm deemed to sell it there. Next one, guys. We'll come back to what the executor does with it just now. It says the primary residence was left to his children. The residence had a base cost of 300 and was worth 1.8 million when he died. So what are we going to do as part of the solution? We are deemed to sell it for 1.8 million. Base cost 300, but it was a primary residence. So the full 1.5 million is going to be an exclusion for primary residence exclusion. You're going to take it off. Okay. You deem to sell it at market value, date of death. Next thing. It says listed shares with a base cost of 60 and a market value of 100 at the date of death that were passed on to his son. Okay, when the market value was 120. Guys, you're deemed to sell it at market value, date of death. So what's going to end up happening? Deemed to sell it at market value, 100. Base cost, 60. Guys, comfortable with that? And the next one. It says, unlisted shares with a base cost of 10 and a market value at the date of death of 135 were sold for 270. As far as the dead person's concerned, market value date of death 135, base cost 10. So what do we do in the solution? 135 less the 10. And remember, because he's died, the annual exclusion for CGT is 300,000. Okay. And inside the question, it says that the deceased has got an assessed capital loss carried forward of 35. It says here, what are the capital gains tax implications of Mr. A had a 35,000 assessed capital loss carried forward? Please just remember the order that you do things in, guys. You do the 300 before you do the assessed capital loss. Please make sure you do it in the right order. And there's your net capital gain. It's an individual times 40%, and you can calculate your tax. So that's what happens. When a deceased dies, you deem to sell everything at market value. So guys, if you're a 4861 student, we've covered everything that you can get as part of your exam. What I'm about to do is only for the 4862 guys. So the executor has to do a tax return. The executor. So what happens with the executor? You deemed to buy at market value, date of death. So all of these proceeds, guys, all of this in the question, what the guys deemed to sell, that becomes the 600, the 1800, the 100,000, the 135, becomes the base cost here. There's the 1.8, by the way. We'll unpack it now. So that's what his base cost is. He's deemed to buy everything at market value. Okay? Let's just explain how to work out proceeds. Now, as far as the executor is concerned, there's one of two things. He can either give it to a legatee, okay, or he can sell it. If he gives it to a legatee, guys, your proceeds is equal to base cost. There's no capital gain or loss. There's no CGT. So whenever it is given to a legatee, your proceeds is equal to your base cost. So let's just go back to this question. It says here, holiday home. It says in terms of the will, it was given to his mistress when the market value was 630. So when it's 630, it's given to his mistress. Because it's given to a legatee, guys, what happens in the solution? There's no capital gain or loss. 600 is in your cost. 600 is in your proceeds. He's given it. You don't show any capital gains or losses. So it doesn't matter what it's worth when you give it to the legatee. You show it at market value, date of death. There's no capital gain if it's given to someone. Whereas, guys, if it is sold, okay, it's a normal CGT calc. Okay, so let's look at the question. It says here, unlisted shares with a base cost of 10 and a market value at the date of death of 135 were sold for 270. So we just do it normally, guys. What are we going to do as part of the solution? There's the base cost, the 135 over there, market value, dates of death, sold for 270, and you allowed to put it in there. Okay, so you do a normal calc. With the primary residence, I just wanted to show you something. You will see, guys, with the primary residence itself, if the executor adds on to the base cost, look what happens here with the question. It's just normal rules for an executor, guys. So what it says here is, it says the house was sold by the estate for 2.3 after 100,000 worth of improvements had been effected onto the primary residence after the date of death. It took 5 months to sell the house after the date of death. Guys, you'll just do it normally. What is my base cost? My base cost is the 1.8 million that he got it for, plus the 100,000 rands worth of improvements. I'm going to include it there. Now, guys, I need you to understand something. With the executor, guys, you'll see that there's a primary residence exclusion of 400,000. Inside the Act, it says the executor has got 2 years to sell the house, and the house can still get a primary residence exclusion after someone dies, as long as the executor sells it within 2 years. You can still get the primary residence exclusion. So I just wanted to point that out. The second thing is that the executor is treated as a human being. So there's a 40,000 rand, okay, CGT annual exclusion for the executor. There is a 40% inclusion rate for the executor. It's like a normal person. And where do executors pay tax? They pay tax on a normal table, but they do not get primary or secondary rebates. Can you see that there? So if you're ever asked to do the calculation for an executor, treat it like a normal individual. They do not get an interest exemption because they're not alive. They get a 40,000 rand CGT annual exclusion. They have an inclusion rate of 40%, and they're taxed on a normal tax table as well. And that's what I just wanted to point across to the 4862 guys. So this is an example of what would happen if someone were to die in the middle of a question. Okay, and I just want to remind you, the estate duty calcs, you're not going to get a detailed one. It's at a level 1, so just a basic thing. Know that it's assets minus liabilities minus deductions times 20%. If it's more than 30 million, whatever the portion is above 30 million is that 25% estate duty. You do not need to know how to do detailed calculations for estate duty. Do not go overboard with it. You just need to do basic calculations. Even when estate duty is asked in a board exam, very, very straightforward. Guys, how does estate duty work? If you sell it, it's the amount you sell it for. If you don't sell it, it's market value, date of death. The only exception to the rule is unlisted shares, which are always at market value. But you guys can have a look at it, and there's a summary in the handwritten notes for you as well. Any questions, guys? Why is the primary exclusion 400? Because, 2.3 million here, can you see? Less the base cost of 1.9 million. Over there, guys, 400,000 profit in the primary residence. As long as you sell it within 2 years, you get the 2 million primary residence exclusion in the executor's hands. You've got 2 years to sell it. That's what happens. Okay. Personal use assets work the same way, guys. You can sell personal use assets. There won't be any CGT on the sale of personal use assets. Okay. So that's there. Any questions? So I just wanted to go through basic approach on a normal individual's question, and then also just explore what happens if someone dies for the 4862 guys. Any questions? Okay, so that's there. Good luck, guys. I can honestly say that for this test, if you practice a lot of questions, you will be rewarded in the test. Because if you're going to get a number crunch question, guys, if you know how to do a number crunch question, you should do absolutely fine. To me, I think that test 3 is the easiest test during the year. I really, really do say that. Because generally there's 20 or 25 marks worth of individual tax calc, and I don't think it's that difficult to do. If you can read properly and you know to put in all the null numbers, most of the time people don't do well because they don't put the null numbers in. Okay, if you know how to do that, you'll be able to do things properly. Okay, so just have a look at that. I think they've just posted a lecture evaluation form. I'd really appreciate it if I could get some feedback from you guys. And yeah, that's there. Okay, so that's all of the stuff here. So what have we done over the last 2 nights? I've shown you how to do an employee's tax calc. I've shown you how to do provisional tax calcs. Shown you how to do a retirement calc with multiple lump sums. I've shown you how to do the board question. Constance did an old exam question with you that has got trade in it. So we made sure that there was one question that had trade in it as well as a salary. We've done that next board question, which has got section 23M in it. We've basically tried to do examples of just about everything that's inside your syllabus with you. Is that okay? Guys, I will post 1 or 2 videos and I'll put it into the announcement section, but I'm going to do some discussion questions on fringe benefits and stuff like that. I will post it into the questions for you, just to show you how to do discussion questions on fringe benefits. It is the one thing that we have not done as part of this course, and I've not done discussion questions on employees tax. So there will be a couple of extra questions posted with videos, but they'll be short little things like little 5 or 10-minute videos covering how to do a discussion question on fringe benefits or discussion question on employees tax and fringe benefits and stuff like that. So that will be posted into the announcement section in the next week or 2. So you'll have it in lots of time in advance before your paper, and we'll put it in there. The other thing that I will do as well is I'll take last year's class tests and I'll do a little video for last year's class tests and actually present it to you as well, so that you've got a couple of extra tutorials to do. Okay, and we'll put those into your announcement section as well. Okay, thanks guys. No more questions, so we're going to finish off now. Constance and the other guys, thank you for assisting me tonight, and thanks. Cool. Thanks for tuning in, guys. I'll see you guys. You'll see me just putting stuff into the class. Thanks. Cheers, guys. Cheers, Constance. Thank you for helping.